Krishna, good morning to you. You think the Fed's got itself in a tough spot? Why?
I think when they keep talking about data dependency, it's a problem. Rates are not at 3%; they are at closer to 5%. Inflation is meaningfully lower, if not trending lower. Worst case, it's stable. In that scenario, they have plenty of room. So I think talking about data dependency for the second cut gets themselves in a position that they have no reason to be in.
Governor Waller brought up the prospect of this jobs number being a whole lot weaker. And he also pointed to the fact that the jobs number drops in a quiet period. The quiet period's been a bit of a problem for this Federal Reserve. He even acknowledges that and basically alluded to it, that he hopes other people will pick up the mantle and explain why the jobs number is so much weaker than it may well have would have been. Now, I'm wondering whether we've got a problem here, and if the problem is the length of the quiet period, or the problem that they're data point dependent, we need to come out and explain in the quiet period what's actually happening. Which one is it?
So I think this series of data is going to be so messy that deriving any information out of it is going to be tough. It's going to be, anyone who comes up with an explanation is basically trying to come up with something to fit their priors. That's how it'll definitely play out for them. But I think after cutting 50 basis points in the last go-around and having laid out a path in their SEP as to what they are going to do, doing something very different based on this data set, I think will probably show their muddled thinking more than anything else.
At this point, does it matter? If they cut rates again this year, is that basically just going to support this bid into equities? Because ultimately it will just show that this is a Federal Reserve that has a bias toward cutting rates, wants to see a durable, landed economy, and frankly, it sees a lot of room to cut.
Well, so none of that is wrong, right? This is a Fed which is hell-bent on cutting rates because rates are too high. And things are going their way. And they want a soft landing. So if that's how they execute, that's what they have laid out in the SEP. I don't think you can hold the Fed, hold that against the Fed, because it is the right policy move in the current context.
So where's the uncertainty for stock investors? Where is sort of the lack of clarity around the Fed's path of travel and where they're going that will make certain data points more important than others for people who are bull on?
Well, so I think the path of the Fed over the next few quarters, I think, is pretty well determined given where rates are and where inflation is. And I think what would be uncertain for it probably is far more uncertain for bond investors than it is for equity investors. I think equities, as long as growth is decent, profitability is good, and the Fed is inclined to cut rates rather than raise rates, I think that path is pretty defined. It's really the bond investors who have to worry about, which is, is 4% the right level for bonds in the current context if inflation picks up slightly because of slightly better growth and slightly better employment levels? I mean, that doesn't change the equity outlook. That changes the bond outlook meaningfully.
Do you think about it in the context of the U.S. economy or the global economy?
Well, so I think that Julia was making a really good point, which is the U.S. economy is able to kind of drive itself, or the markets can drive itself off of the U.S. economy because the global shocks are very well contained. That is, there's nothing really happening in Europe. There's really nothing happening in China that is meaningfully different than the trend that we have seen. So I think from that standpoint, our markets, we can figure out where they are going based on the U.S. economy and the U.S. rate.
Well, this is what I'm trying to figure out. The U.S. economy can basically operate as a bit of an island. Mm-hmm. We're talking about a global fixed income market, and what happens in Europe, what happens in China, has some consequences for where that 10-year yield trades, surely.
Oh, absolutely. I think if China was going into a deflationary cycle and they were not doing anything. Yeah, well, it is, but the path of deflation is much slower than I think we have imagined over the last few years. And they are they're not doing much to revive it, but they're doing something. So in that context, thinking of a savings glut and taking rates to 2%, I don't think that is in the cards anytime soon.
At the same time, does it make you very confident on being bullish the dollar? I do wonder, based on your call and based on some of these rate differentials, whether that's an increasing kind of focus for people.
Well, I think if the U.S. dollar is going to remain strong, it is going to be because the U.S. economy continues to do well rather than level of rates. So I think I sincerely believe that, because the difference between the U.S. economy and every other large economy in the world is so substantial that in that context, unless we be screwed up royally from a policy standpoint in the new administration or something, or in with respect to the Fed. I think the dollar has enough support from the economic picture that we are seeing unfold in front of us.
So what are you doing right now?
Well, so what we are doing is basically nothing, which is and there's a reason for that, is because the way you don't do anything is actually expressing a view, which is you're not if along with not doing anything, you're not rebalancing.
Are you just holding on to the desk, as Julian Emmanuel told us, and waiting for the election to be over?
We are looking at the screens and feeling really good about what the equity market is doing and not cutting the equity exposure as equity exposure has increased.
You're allowing the equity portion of the portfolio to take on a bigger role in the overall portfolio, correct?
Exactly.
And why are you so much more comfortable with that?
Growth. I think yesterday when somebody asked Moynihan whether it's soft landing or no landing, I think he was basically saying the same thing for both scenarios, which is I don't think people confuse soft landing and no landing. It's really the same scenario. It's exactly, as long as that continues to unfold, I think we are in a good shape.
We typically talk about a 60-40. Are you questioning the risk mitigation characteristics that Treasuries can provide, given the risks on the table into 2025?
I think Howard answered that question for you when he was here. With the plans that they have, if those unfold, I think the uncertainty with respect to bonds is quite substantial. And I think counting on bonds to provide a significant level of counterweight to your equity portfolio, I think cash does much better than bonds in this context.
Are you saying that essentially the reinflation risk is the biggest potential risk right now, that potentially is a difficult one to hedge against, other than just going again into stocks?
Yes, I think for bond investors, the reinflation risk is basically unhedgeable at the moment. That is, you can from a short-term perspective, you can probably put on some hedges, but that's not going to solve your real long-term political problem that you'll be facing. So
I'm pleased you've said this. This is refreshing, and I'll tell you why. We've heard a lot of boilerplate nonsense on this program around the election. A lot of people coming on and saying it won't make much difference. Look back to previous election cycles, stocks go up to the right. I think this is very, very different. What's on offer here? And I'm not going to say which one's the better one. The American people get to decide that. But there are two very different visions of policy in America for the next 12 months, surely.
Oh, absolutely. I think, and Julia was kind of addressing that particular issue, that the two policy paths are very, very different. They may have the same outlook for equities. They sure as hell are not going to have the same outlook for bonds.
So let's look at Kamala Harris for the bond market.
I think Kamala Harris for bond market is probably not as bad as Trump for the bond market, if the current set of policies that are on offer get implemented.